Hello, this is Sergio Marrero, and we're here at Rebel1 Live with Nitin Rai, who is managing partner of Elevate Capital. Thanks for joining us, Nitin.
Thank you. Thank you for inviting me.
Yeah, happy you were able to join us, and excited to hear more about Elevate Capital. For those that don't know, Nitin has his roots in India, but has been in the U.S. for some time and has heavy roots inside the Oregon tech ecosystem. So excited for him to share a little bit more. We always hear about New York and Silicon Valley, and but excited to talk about Oregon today and how they are accelerating innovation. But turning it over to Nitin, if you can share with the audience a little bit more about Elevate Capital.
Sure. So Elevate Capital has been around for about 5 years. And it sort of started out with this, it wasn't even my idea. I mean, I was angel investing through an organization called Thai Oregon and Thai Global, which is a network of chapters around the world, started by people from the Indus region. But in Oregon, we were not just Indus, we became inclusive. And the idea of Elevate really came out of our earlier investments that were made in women and minorities and people of color, and tying that with mentoring. So 5 years ago, I ran into a person who is now my lead investor, Rukaya Adams, who is, she's the chief investment officer at Mar Memorial Trust. And, I formed Elevate to invest in women, minorities, and people of color because I saw a gap, I saw an opportunity. And me being a minority myself and having had my own personal challenges in raising capital and butting heads, the glass ceiling in the corporate world, that it just made a lot of sense that's who I should support and invest in. And that's where Elevate Capital started. The first fund was $10 million. We made 29 investments, and our thesis at that point was to really focus more in the Pacific Northwest, but with the lens of inclusion. So 75% were in Oregon, a few in Washington State, and just a few outside of Oregon, specifically to find African-American, Latinx tech entrepreneurs, where we don't have a lot of pipeline here in Portland for technology. And we built a really successful fund. We got 2 exits, returned 40% of capital back in less than 4 years. We rank very high. If you look at PitchBook, we're in the upper quartiles. And based on that track record, we launched Fund 2 earlier last year, and then had to delay it because of COVID. But it's a $40 million fund, same thematic approach, except that we have the nation, the entire country open to us. And again, very intentional about supporting Black and Brown founders and women and founders of color. And we just did a first close of 26 million. Our lead investor,
congratulations,
is Meyer, lead investor. And then the state of Oregon also became a co-lead. And then, a lot of the funds have been raised from Oregon, but also from outside of Oregon. Excuse me. And we announced 6 investments because we had a burgeoning building pipeline of entrepreneurs from around the country. So the first 6 investments we made, new investments, were all in Black founders, 5 women in tech and healthcare, which is our core sectors that we're focusing on. And of these 5 women, 1 raised over 2.1 million. One raised 3.9, both oversubscribed. And in one case, we were a lead. The other case, we co-invested. So we're really excited about that. And we have more founders that are applying. And we are very, very excited about investing in these founders across the country.
Amazing. So, okay, great. So now you're open across the country. What types of founders should reach out to Elevate Capital? Are there particular industries of focus, size checks that you're looking for?
So our typical check size is going to range from 100,000 to up to $1 million. And we like early stage. So more than half the fund is in seed stage, and it could go anywhere from pre-seed even pre-revenue, depending on what the deal looks like, to where they have monetized, they've got some product market fit, essentially pre-Series A, and then we have an allocation for Series A and some follow-on. So now within that pool of money, our check sizes have ranged from 100,000, 250, 150, 500, 600, and soon to be $1 million check. And the sectors that we do well in and that we really have backgrounds in is medical devices and healthcare software, digital health, maybe a little bit of life science, but no biopharma. That's not our expertise. And then on the tech side, software as a service, B2B, B2B2C, B2SMB, and we can go on that sector. There's several different iterations of that. IoT, a lot of people say, oh, I do AI, ML. Well, we think AI, I'm an AI guy. AI, ML is just really baked into what we're looking for is disruptive products. And they don't have to have a TAM of 10 billion. They have to have a reasonable TAM. It could be a vertical niche where they have maybe a better mousetrap or some new invention, a new technology that's disruptive in that vertical space where they have first mover advantage. And also have a diverse team. So we'd like to see 2 co-founders. We like to see diversity. We're not opposed to white males, but that's going to be pretty less. So if you look at our Fund 1 metrics, 55% of our investments were in women-led companies, 18% African American, 11% Latinx, 7% LGBTQ, and 45% of the founders were founders of color. In Elevate 2, I think we're 2xing that. And 80% of our founders were diverse. So we're kind of heading in that same direction, probably do better on the women and African American and Latinx. We're very intentional about that. The other thing that's very unique alongside our investment is that we're an entrepreneur first fund. So most of us that are involved in the fund are exited or successful entrepreneurs. So we bring both industry expertise as well as success in building not 1, but 2, but 3, multiple companies, getting them exited out. So exits are very important. Outcomes are extremely important. We are seed planters, so we know our lane. So we like to grow the seedlings about 6 inches, and then we have a network of growth equity firms, other venture firms, who like to come in and do the next round. We co-invest, or sometimes we get early exit opportunities. We do that, but that's kind of in general to answer the question of the sector and the type of founders. We invest in jockeys, by the way. So markets.
Say more about that. What do you mean by jockeys?
We are looking for founders who are motivated, who are hungry, who are willing to take our advice. As in form of mentoring, who are transparent, who are collaborative, and have skin in the game in the sense of really understanding the market. We love founders who have domain expertise, or if they don't, they have advisors and people in the company that have domain expertise. Because ultimately, especially when you look at B2B, a lot of that is tied to domain expertise and how you create products that are disruptive or adding value with technology in those different domains. So those are the folks we like to work with.
Amazing. And I think you spoke about it before, but the audience may not have caught it. That's a big deal to return, 40% of your fund within, 4 years time. It's 3 to 4 years like that. Can you talk about how did you do that? What were the elements of what you looked for, or how did you support them? Yeah.
It was an intention. And the reason we baked the idea of early exit, not that every company with early exit, but first of all, we're not chasing unicorns, right? So we don't invest in a company because we think in 15 years it's going to go public and one deal is going to pay out of the 20 jumbo jets I'm going to invest in, one will pay off or 2 will pay off and return the fund. We're not thinking about it this way. We're an impact fund. We are mentor capitalists. We are not venture capitalists. So for us, there's a social good element. There's a social impact element tied into sort of the companies and who we invest in. So what we're looking for is we're a nursery. So, how big do you grow the plants, right? And so the idea is that we want to be able to return capital back at a much faster rate from more companies than this 18 and 2 rule, right? So we're investing in more companies. We're investing in about 30 companies. And we're rolling up our sleeves to really help these founders sort of get to their next and the next and the next milestone. And our funding thesis is we will continue to support them through follow-on investments. Sometimes we will lead bridge rounds, which most VCs don't do that, but we will. Getting them to a point where they're hitting enough milestones that there's another investor or there's an acquisition opportunity that comes in that gives us early liquidity. So we're looking for 4 to 7x in 4 to 7 years and turning a larger portion of our fund out. So what happened in Fund 1 was, as we talked to the founders, we also talked to them about this strategy that we have. And not that they all have to follow it, but a lot of them like that idea because many of them are first-time founders, right? They've never built a business before. And, if they can get in 7 years, create some wealth for them and create generational wealth for their families and their communities, why not, right? So, and if more of them do it collectively, you're creating a fair amount of wealth in those communities and in those founders. And it also gives us an opportunity to get out and then recycle that money. So Fund 2, more than 60, 70% of the investors are from our previous fund. So people are just recycling these returns. So what happened in Fund 1 was we invested in a company grew 1,600%, and then we kind of helped them figure out what their next path should be to grow and scale. And we suggested a growth equity firm that we had done a similar sort of thing in a previous investment as angels. They came in, they made them a huge offer, and we didn't even have money to meet our pro rata. So, and we were still raising Fund 1. So this was within 18 months of starting it. And it just made sense for us to get out at 7.2x, which paid about 40% of the capital back. Then there was another company that was in the food space, was again very targeted. They wanted a specific amount of capital to build X number of stores, and they had to acquire in the back burner. So we got 2x right before COVID, before the restaurant industry shut down. So those are two examples of it. I have plenty of other examples from our angel investments. And as we've invested out of Fund 1 into companies that are growing, many of them are gearing up for liquidity in the next 2 to 3 years. So, and we'd like to just, we're not interested in waiting for an IPO. If we get a chance to get out, even partially get out, we will.
Great. I love you talking about, entrepreneur first. And I know a lot of funds say, oh, we're founder first. And you talk about this differentiated focus of not, of not just betting on,
markets,
betting on, $1 billion exit, but having, a better yield on your, the company or your portfolio and what you invest in. What are some of the things that, because you're nurturing them, you would assume that they're taking longer periods of time? So how are, how are you able to scale that support?
Well, so first of all, it depends on the deal, right? It depends on the market and it depends on when we're coming in. So if it's a med device company, sure, they're going to take a longer period of time. If it's a blue sky, and we did a deal out of Fund 1, totally blue sky, pre-revenue, very successful founder who I used to work for once upon a time, and walked out of the company to start my own company and missed out on IPO. But what we look at in those kinds of companies is, what's the DNA of the founder? Have they done this before? Who they've got on the team? What is this idea? How blue sky is it, right? So pretty big blue sky idea, pie in the sky. What have you done with in terms of market validation, research, customer research? Customer validation is very, very important. And in those cases, we're willing to come in early to help. And do they have any potential partners who've sold them, hey, if you build it, I'll buy it, right? So we look at all of that and then say, yeah, so this isn't going to happen in 3 years. This is probably going to take that 7-year time frame or maybe even longer. So then we start small, then we build up, right? So we may come in at like 100K, 150K, and then we start supporting them. And this one company, we've already put $1 million out of Fund One, and it finally is monetizing now because now they've got the product and they've figured out the product market fit. And it took a while because it's a IoT company. And so we'll do that, right? Or it's a B2B SaaS company where the founders have already put together the product, they're domain experts, they have some product market fit, and they just need some money to really go to that first level of sales. And if there's good product market fit, which means lots of customer validation, they can scale pretty fast. It's high, it's efficient selling, right? Of software into enterprises, even including large enterprises, where if you're really solving the problem, people will buy fast. And if the pricing is appropriate, that they will buy quickly. So we've had situations like this. So it all depends on the deal, to be honest with you. But typically, SaaS companies, in my experience, that we've invested both as angels through Thai Angels and what we've done through Elevate, within a couple of years, if they're scaling, I mean, I look at the 2x. I say if they're doubling sales every year, even if the revenue is not catching up, if their bookings are 2x every year, that's a pretty good number. That kind of growth rate for business-to-business software. So we look at that. I don't know if that answers your question.
No, it did. It did.
Yeah.
And
then many exit multiple opportunities because you got a stack of investors that come in at Series A, you got a stack of investors that come in Series B. And as the company gets bigger and more successful, the founders are not willing to give up too much of the equity. So these big guys, the growth equity guys, when they come in, they want to own more of the company, but they can only get 10% for $5 million. Well, where are they going to get the rest of the company? Guys like us will say, hey, buy us out, portion of us out, and you can increase the stake because the founders don't want to give up more of the stake.
That's great. That's a great, a great secondary strategy. A lot of people don't talk about that.
We love secondaries. We love secondaries.
Excellent. If you're taking a step back, I want to hear a little bit more about your story. You've been doing this for over the past 5 years. Can you share a little bit more about your journey?
Well, I've been investing for 10 years. So let me give you and I'll try to abbreviate it.
I mean, we're here.
So everything that's happened to me in my life is an accident. I ended up in Nova Scotia by accident because I was interested in computer science. And growing up in India, high school, there was no computer science program. There were engineering or medicine, which is what I was really interested in. But I changed my mind and ended up in Nova Scotia and I had family there. And so, enrolled in the computer science program, did quite well, piled up all my courses, in 3 years. I got my 4 years done. And then, as a nerd, just being really around all the nerds, I just never fit that mold. I grew up in India, in Delhi, and went to an international school where I was exposed to lots of different cultures and lots of different students. And I never was that nerdy student in high school or even in school. I was very much into extracurricular activities. I connected with a business student organization called ISAC, which is a global organization. And ISAC has a job exchange program. And so I applied. And I was learning French. I thought I'd go to a French-speaking country. But the computer matched me to their mainframe system that matches jobs to candidates, matched me to a startup in Silicon Valley because I was doing AI. And it was a dream job. And so I had no money. I borrowed money and arrived in Silicon Valley with $50, taking a bus from Halifax to New York and then to Silicon Valley, and started my career as an engineer and worked for 2 startups, moved to Oregon to work for a larger company. And eventually, I realized that I could not work for anybody. So I started my own company called First Insight, which is now 26 years old. And we were, I discovered the opportunity to create electronic health records in the eye care business. And I had my optometrist who had created the prototype. I paid him $3,000, and I had no money in the bank, but paid him three because I get the three from one of his customers, one of my new customers that was a friend of his. That's how I started. I couldn't raise any money. Nobody believed in the idea. And of course, nobody believed in this in Portland, which is the whitest city in America. And we're talking 1993. So I was not worked into anything. I kind of self-funded it, did consulting, and eventually raised capital, a lot of capital to go public in 1999, 2000, but then the dot-com crash happened. So long story short, I bought my VCs out, and I swore I would never raise money again till the Thai opportunity.
Until you became a VC.
Well, I don't call myself VC. I call myself mentor capitalist or MC. And so we launched Thai in Oregon, and we were going to serve the 6 billion. That was the thesis. But my thesis was, and clean energy and sustainability. But my thesis was, I want to help the entrepreneurs. I don't want them to make the same mistakes that I did, like raise money too early and those kinds of things. Like, I'm a firm believer in, if you can self-finance it, do it before you go ask for money. Prove your thesis. So I proved everything, and then I was able to raise money, and lots of money, which all went to waste anyway. So I had learned the venture capital experience. So I started advising entrepreneurs through our mentoring program, and a female entrepreneur by the name of Monica Enand, who's of Indian descent, but born here. She came to me one day and said, "Hey, markets have crashed. There's no money in venture. Would you consider investing?" And what I was hearing was, "You better invest in me if you want to be relevant as an angel," because we hadn't done angel investments yet. So that's what launched our angel investment efforts. And we started investing in women and people of color. And then because of this early exit model, which was not our idea, it was the idea of the entrepreneur to get. So Monica got us 2 exits, one 4x and the other one 17x over a 6-year period from growth equity firms. So we developed our thesis that we realized that angels in general don't make any money because they park the money in the wrong companies. And the way to do, and we're not in the valley where you could go to a YC demo day and throw a 25K in some deal you may have heard about, or you knew somebody in the network where you put a small amount of money and then someday, got a 2000x return. We said, we're a small ecosystem. We're developing the entrepreneur ecosystem, developing the investment ecosystem. Let's focus on liquidity. And that's what baked the thesis of Elevate. And so I did 17 investments myself. I got now I have 8 exits, but 4 exits returned us 3x cash on cash. We were doing better than a fund, even if you took some fees out, right? And then that word got out, and then I got approached by Rukai Adams. And by the way, Rukai is African American, grew up poor in Portland, ended up going to a private school, and then ended up at Stanford in the 90s, and actually discovered Thai in Silicon Valley, and was always impressed with what my community was doing to help entrepreneurs. So when the time came, she approached me and asked if I wanted to start a fund. And my first reaction was, I don't think so. It's a bad idea, in my opinion, in my mind. But then, when money is on the table, you think about it. So my thesis was really spot on at that point, even though so many people discouraged me. Many people told me that I should invest in my own people, which I thought was ridiculous. One in particular, and I thought that was really racist. I want to invest. My people don't need the help anymore. We spent 30 years breaking the glass ceiling. In Oregon, maybe we still do, but if I were to do it, I want to invest in people who nobody is investing in, because that's where the opportunity is, right? So that's
absolutely, yeah, and so so it was really through the Thai community that that you pushed and got started. No, that's excellent.
And our DNA is give back. So we volunteer. We don't get paid much to do this, right? As fund managers, as a small fund manager. So it's a lot of volunteer time. And I have now built an army of venture partners and LPs who are all rolling up their sleeves and saying, we need to do this. And since this last 12 months, that resolve has become really strong. And, so about a third of the fund is Indian Americans, but we have people from all different communities. My lead investor is Black woman, strong Black woman. So we are very intentional about supporting disadvantaged entrepreneurs. And we feel that women, people of color, are overlooked by the traditional VCs because they, and I have experienced that, they underestimate our ability to succeed and they overestimate our ability to fail, and they overlook us. And that constantly happens, constantly. And that's the part that we want to change.
Absolutely, absolutely. So, and as you were getting started, like now the narrative, I mean, to be frank, right? There's you can say like Black and Latinx founder. It's like a mainstream focus to focus on.
Yeah, it's becoming
impact.
mainstream.
Yeah,
it's becoming mainstream. It's not mainstream yet. Don't get so bedazzled by the media and all that kind of stuff. In reality, there's very few funds in the country that are with that thesis. There are more and more popping up. And I don't know how many of them are really copycats that just want to parrot the thesis to get money. But at the end of the day, again, you look at the outcomes and you say, okay, so let's peel the onion and let's look at who have you really invested in.
And you talked about origins of the entrepreneur being the area of focus. Like, can you talk a little bit more about, you talked about, you're a mentor capitalist. How are you defining impact?
We're defining impact by, our our clear focus is on the outcomes because, investors need to be able to make money. You can't sit there and do fund 1, 2, 3, 4 and do markup stuff, which is what happens in traditional venture capital. Failure is not an option for us, and neither it is for the entrepreneurs that we invest in. We have to succeed, right? And success for startup founders, for any entrepreneur, is measured by what you did with your business and how did you impact your customers, what was the outcome for your investors, and who did you hire and what was the impact to the community, right? And so all of those things are important factors for us. I don't know if that answers your question. But in terms of entrepreneur first, the reason we are unique is because we have gone through this journey before ourselves. So first of all, we relate to them, we connect with them. We have seen this before, so we can pattern match to challenges that they might be facing, where we can be more empathetic rather than top down. So we are not top-down investors. We are not sitting on the sideline investors. I write a 100K check and I ride the wave on the coattails of some big ass VC out of the valley. No, we're not that. We don't do that at all. We lead investments. 70% of the investments that we've made in Fund 1, we led the investments. We wrote the first check. We wrote the second check. So we take inordinate amount of risk with these founders, but we mitigate the risk by being on their board, by being an advisor, by us becoming the ear to this entrepreneur. So when they have an issue or a challenge, they come to us first before they go talk to 10 other advisors. And that kind of tight relationship is so important because they don't have that. They don't have friends and family money. They don't have the network of mentors. And what we offer is the experiential part that we've already gone through this journey before, and we're willing to pay it forward with our time, not just our money.
Absolutely. And as you prepare to, or you already have, right, started to look at deals outside of the Oregon area, what types of things are you thinking about doing differently than you did in Fund 1?
We're doing the same thing, other than the sectors. In Fund 1, we invested. So Fund 1, we didn't know what pipeline we would get in Oregon because the focus was Oregon, Pacific Northwest. And the tech pipeline is not so strong, right? In terms of, if you start looking at women and minorities and people of color, we didn't know what we were going to get. So we kept the sector piece open. And we said, okay, what are the areas of excellence in Oregon? Well, there's food, there's beverage, there's apparel, there's consumer product. And of course, there's tech. I mean, tech is big. Intel is the largest employer here. So we kept it wide open, but we ended up doing mostly tech, but we also did other stuff, right? And from there, we learned that, okay, consumer product is not our core expertise. So we're not going to do that out of Fund 2. Food and beverage, not our core expertise. Not going to do out of fund two. Med device, yes. We've got some people in there, and we know the returns are decent. So we're in markets and spaces where we have expertise, where we can add value to the entrepreneur. So when we look at a deal, we also put the lens on and say, can we add value to this team? And if we can't add value, then we will not invest, no matter how hot the deal might be. We're like, if we're not adding value, then they can get money from elsewhere, and they do.
Great. And no, that's as I look at your some of the founders you invested in, the founder of Blendor, we've gone way back from some of her early days, and as you're thinking about different underrepresented founders, it's clear that you're dedicated.
She was our first investment, and we were her first institutional investment. She drove 15 hours overnight from San Francisco to Portland to collect her first $50K check.
That's amazing.
We're super proud of that. Yeah. And and that is work in progress. I mean, Stephanie is a work in progress because the problems that she was originally trying to solve, she, again, using our advice, pivoted to become more of a data analytics play to enterprises. But then COVID happened, and then you realize, and she will tell you openly that you realize that some of the games that these big companies were playing around diversity was this sort of like, yeah, it's window dressing, and now she's repositioning it to really go after the ESG space, where there's a mandate that Oregon's just passing a law here pretty soon that any public board must have X% representation from minority, people of color and women. California has that. So, Wall Street is now moving in that direction because a lot of the large pension funds and fund of funds are demanding, ESG metrics. So, she's going to get there. She's done well. She built $1 million business. She was able to raise money, not as much as we'd like to see, but we're there supporting her, and her investors have invested. They are very focused on supporting women, and women of color are all supporting her. So.
Yeah, and she's brilliant.
And she's persistent.
She's insanely persistent, really smart. And
this is the pattern I've seen with women founders, right? So I've been investing in women founders for almost 10 years. They come better prepared, much better prepared than the guys are. And they have much more realistic expectations of themselves and of their investors. And they really are looking for mentors. But they come more baked and more prepared, and also putting more of their own money. However they scrounge the money, they come much better prepared, and they know their domain also really well. A lot of them are domain experts, which is just such a joy to see that. It's not a 19-year-old in a hoodie who wants to rule the world. That's not who we invest in.
Love it.
There's nothing wrong with it, but then that's not who we are. We were never 19-year-olds in a hoodie. And so, we kind of, we do what we know, and we don't do what we don't know.
Got it. I enjoy the especially the differentiated perspective in the venture investing space, Nitin, that you provide. Can you share with the audience a little bit more of what's next for Elevate Capital?
Well, we have to close our fund. So we're at 26 million. I got 14 more million to raise. We gave ourselves 2 years, but we were able to get to 26 in about 6 months of, sitting on our asses and, doing Zoom calls day in, day out. So we're very thankful to all of the investors that took a chance on us and realized that they can do a lot just virtually, and you don't need to have that face-to-face, which saved me so much money and so much angst, on airplanes going all over the country. The next is getting the fund fully raised, which I and one partner and one other associate. By the way, we are also a Black VC fund, so I have an associate and a venture partner, both African American, and that's very intentional. We are basically, hoping to get this fundraise done within a year, and also making investment. So we announced 6 new. We've also done 2 follow-ons into 2 Fund 1 companies that will that announcement will come later. And we're just getting, we're inundated with inbound requests. So this last week's media blitz, our CRM system has been ringing off the hook in terms, and then people just emailing me. I don't know how they found out my email address, but there's a lot of inbound coming, and there's stuff coming from our partners. Lolita Taub, I want to give her a shout out. Her matching tool has been great for us. And so, building a network of, trying to build a community of fund managers like us where we can do some deal sharing, so it's all, we're on, 10, all cylinders firing right now, both, investing, pipeline, sitting on boards, raising money. That's typical of what VCs do.
Amazing. So, well, thank you very much, Nitin, for sharing the story, your story, and the story of Elevate Capital. And for everyone that tuned in, this is Rebel One Live, interviewing VCs and CEOs every week, and accelerating diversity in the investing and founder space. So thanks again for joining us tonight.